Thanks, Tom, and it's great to be here. Thank you, everyone, for attending. We're developing a MOP project in northern Morocco called the Chemisette Potash Project. We're listed here on the London Stock Exchange. It's fantastic to follow Peter Albert, a project that I know extremely well, and I guess imitation is the highest form of flattery, and we are unashamedly imitating the investment thesis of Highfield Resources because we agree very strongly with the thesis that capital cost of production is probably the biggest hurdle you need to get over, but then also location is the biggest driver of your competitive position. This is just a map showing where we're developing our project. Similar to the Highfield, the Highfield project, we are very, very well located, close to the coast. You see here in the red. What's interesting about Morocco, however, is, as Alexander mentioned, there is a large fertiliser company based down in Djouf-les-Fars called OCP, world's largest producer of phosphate. So there is a very large local market in Morocco as well. My experience looking at the potash industry, the conclusion that I've come to, and this I guess gives a slightly different perspective to Alexander, is there are really two attributes that you need to be successful in a greenfields potash development. The first is low capital cost of production. It sounds obvious, but there has been only one greenfields potash mine built in the last 50 years in Canada, and that is really a reflection of the astronomically high barriers to entry in the form of capex. The second, which is somewhat, I guess, it always causes a little bit of consternation amongst mining people, is grade is not the most important driver of your success in your competitive position. It is, in fact, location relative to your end customer. As Peter outlined for the Highfield project, it is fantastic to be on the doorstep of your customers. In terms of the Moroccan assets, we are among the lowest capital costs of production in the industry. And you see we're less than half of the average capital intensity of the rest of the peers. The only group that is competitive with that is, in fact, the Highfield Resources assets. What is the key driver of being low capex? It's nothing to do with the mine itself, but really to do with two things. Access to mineralisation, how do you get from the surface down to that mining horizon? That's driven by a lack of aquifer. And as you see here, we really show the difference, the cost savings that can be made through that geological benefit that we have. On the right-hand side of the typical Canadian projects, where this single piece of investment costs, on average, $1 billion. For us, it's about $35 million, so a saving of over $1 billion for that item of capital investment alone. The second big driver of low capital cost in the industry is access to infrastructure. So Peter mentioned that in Spain, the infrastructure is outstanding. In Morocco, it's no different. So we have incredible access to roads, ports, electrical infrastructure, all of which results in huge cost savings for a development project like this. So the second point I made is actually location is the most important driver of your end margins. Grade is a nice thing to have, and it will drive your cost to mine gate lower, and this is perhaps where we differ a little bit in our viewpoint from Alexander. If you look at a typical mine in Canada, and you look at the cost structure of that industry delivered to a market like Brazil, which is one of the most important markets on the planet, you see that transport, logistics and royalties typically makes up over 60% of the Canadian mine's cost. So while they may be very low cost to their mine gate, when you factor in all of those additional costs, the advantage of being in somewhere like Morocco relative to Canada delivering gives us about an $80 a tonne advantage over those Canadian mines. In a commodity where the value of that product is only between $300 and $360 a tonne, that is an incredibly large advantage, and it is one which is unerodable. So the competitive advantage is clear, and I guess I reiterate what Peter said, that location is the most important driver of your competitive advantage in this industry. We delivered a scoping study in November of last year, so we are a couple of steps behind Highfield Resources, but it confirmed, number one, that we're very low capex. We're in the bottom decile, certainly the bottom 3 or 4 projects in terms of capital intensity. And as a result of our location, we expect to be bottom quartile delivered costs to the very large Brazilian market, but even better than that, delivered into the African market, which is growing, and I'll get onto in a moment, we would expect to be certainly even more competitive than that. Africa is a market that is not mentioned widely in the fertiliser space, despite the fact that it is clearly a driver of the overall demand in this space. We're seeing significant amounts of growth, albeit from a very low base. But I think it's very clear that the future of fertiliser consumption is going to come from this region. It has about 600 million uncultivated arable hectares of land, about 60% of the world's uncultivated arable land. If you believe the long-term thematics for the agricultural themes, it's clear that Africa must become a centre of future food growth, and with that, a massive increase in fertiliser consumption. What this map shows is, in the red, incredibly low fertiliser application rates across Africa. We expect that to grow very strongly, and we are already seeing that happen. So Africa is growing in general for fertiliser consumption at about 30 to 35% per annum, compared to a global growth rate, which Alexander mentioned, of between 2 and 3% per annum. So a huge differential. But then if you look at Morocco, Morocco is top 5 fastest growing import nations for potash globally. It's growing at 70 times faster than the global market for potash. What's driving that? It is purely driven by OCP, the world's largest producer of phosphate rock and one of the largest fertiliser companies in the world. They are importing potash to blend into their NPK blending to then be used in their global distribution network, but with a clear focus on Africa. We are obviously ideally located, once we move through our de-risking milestones, to address OCP as a key customer and potentially a key partner of us as we develop this project. So all of those things that I have outlined in our scoping study led us to absolutely outstanding fundamentals, project fundamentals. So the economics are as good as anything you would see in the industry. A post-tax NPV 10 of $1.1 billion based on Argus's price forecasts. Capital cost of $400 million, which includes a $90 million contingency, puts us in the bottom 2 or 3 development stage projects in the world. EBITDA margins based on today's prices approaching 70%, almost unheard of in the mining industry, and post-tax cash margins of around 50%. I think it's important to note that talking about the financing of these sorts of projects, because it's not a hedgeable commodity, banks will take a downside price risk on these. So they will run their pricing models at the lowest possible price that they can, which means that the vast majority of potash projects are extremely hamstrung in their ability to get any sort of debt financing. In this case, we ran the numbers on the downside scenario, and this project will still make $80 million a year of post-tax free cash flow in the lowest price that has occurred in the last 10 years. That means that it is definitely debt financeable, which is, again, very rare in the potash industry. There's only really one other project that I have seen in Highfield that would be able to get debt finance in that downside price scenario. The project itself is already 20 years, so 2 decades of mine life. We've excluded quite a lot of resource that is economic, but would make up mine life later but there is significant potential to expand in this basin. It has been drilled relatively densely, as you see, in the middle of the basin, but the basin certainly extends to the northeast. We plan to drill a few drill holes. We're in the middle of a drilling program right now to upgrade our resource, but also potentially expand it. But we see this as a multi-generational project, significant scale, certainly well past the 20 years of mine life that we're currently seeing. Talking about the financing and going back to the first point that I made, which is capital cost is the biggest hurdle, speaks directly to your financing discussions. So as part of our de-risking, we have already had early stage discussions with a number of potential debt financing institutions to understand what the potential debt financing capacity of this project would be. And this is where I talk about the downside price scenario. As you see, they ran it at a $235 a tonne delivered price to Brazil, which is about a 40% discount to today's price. So quite a punitive downside scenario. And based on those numbers, this project could still take around 60% of its total capital cost in the form of debt, which is a fantastic position to be in, certainly reduces the amount of equity that we have to finance for the second half of this project. We have a highly experienced team. I think a couple of people that I'll point out are Mark Connolly, very experienced mining executive with a huge amount of experience building projects in Africa. I think it's important. He's onto his 6th mining project that he's building. So he joined the board. He and I have worked together previously. We have Robert Rickson, former Xstrata executive, who found these projects and pulled them all together. And then Phil Cleggett, who's working in corporate development with me. Both he and I worked for Highfield Resources prior to joining Emmerson. So the next steps, we're at a much earlier stage. We've delivered a scoping study, which is a first pass technical and economic assessment of this project. We did a huge amount of work, so it's not to be sneezed at in terms of the amount of engineering and work that we've done. It really gave us the confidence to then accelerate into the next phase of development. Drilling is ongoing at the moment. We will look to release an updated resource towards August of this year. Metallurgical test work is underway, really to confirm the scoping study process flow sheet and make sure that we understand that we can actually produce the K60. That will be released in the coming weeks, I hope. And feasibility study has kicked off in the last week and a half, and we're expecting to deliver that sometime in Q1 of next year. But I think it's pretty clear for us, 2019 is going to be a transformational year in terms of the company and our ability to move this project forward. In summary, we are completely funded for all the work that we have going on at the moment. Not quite as nice a financial position as Highfield, but one of the differences with our project is because of the amount of historical drilling we have into the project, we don't need a huge amount of money to take it through the next de-risking phases. But we are completely funded for all the work that we have ongoing at the moment. This is one of the lowest capital costs, both in terms, absolute terms and capital intensity in the potash industry, and the margins are absolutely outstanding based on the scoping study that we've got. We have experience in potash and a very experienced board and management team in terms of development of mining projects in Africa, and we see 2019 as being an absolutely transformational year for this project as we move through those de-risking milestones and take this forward to production. And I'm way under time, so thank you very much.